Good day, everyone. We are back with another portfolio management series. This time we are going to be talking about playing the mutual fund game. This was brought about because we see a lot of prospective client portfolios. Often these are prospective clients that work with other advisors. And there's an epidemic going on. I don't know what it is, but we've noticed portfolios that are stuffed with active, expensive, inefficient mutual funds. And I've talked about this topic in the past, and my gripe with mutual funds is no secret. They cost a lot. They're not tax efficient. What I really haven't talked about is their dismal performance record. So today we are going to be showing, backed up by evidence, the dismal track record of mutual funds across a wide range of timeframes, from the short term, call it 1 year to 5 years, to 10, 15, and 20 years. And in my opinion, if you are working with an advisor that uses expensive mutual funds in 2023, listen up. This is for you. This could potentially save you thousands or even millions in unnecessary fees, taxes, and subpar performance. I'm going to share my screen. Let's get into it. So let's start with the evidence. Hopefully you all can see this. So there's a company out there called S&P Global that keeps track of every publicly traded mutual fund out there. So this is various fund categories for US equity markets. You have US large cap, mid cap, small cap, and then various styles. So large cap growth, large cap core. And I only shared a few on here, but the point still stands. If I shared every single fund category, the point would still hold. So these are the fund categories in this left column. These are the comparison indexes. So each fund category is compared to a benchmark. And the benchmark is there to determine if the fund managers in these fund categories are doing a good job exceeding the benchmark in performance, meeting the benchmark, or coming in under the benchmark. So outperformance, meeting the benchmark, underperformance. And this company, S&P Global, updates this twice a year. So they do an update in June and an update for the full year, I believe, in February or March. So twice a year, every year, they update these numbers. So let's focus on the all large cap category, which is the largest category in the mutual fund space. So how this reads is these numbers are the percentage of funds that underperform their benchmark. Okay, so the higher the percentage, the higher these numbers, the higher number of funds that underperform their benchmark in these respective categories. So again, looking at the fund category, all large cap, we can see over the last year, so June 30th, 2022 to June 30th, 2021, 55% of all large cap funds failed to beat their benchmark. They underperformed the S&P 500. And you might say that's not bad. And look, it's really not. It's basically a coin flip. But you'll notice a trend. As we move to the right, as the time period gets longer, the percentage of funds that underperform their benchmark goes up and goes up substantially. So looking at this, over a 10-year period, 90% of mutual funds, active mutual funds, trailed their benchmark. They underperformed the S&P 500, okay? Now, there's a few things here. One, this is net of fees. So some of these funds before fees might actually beat the S&P 500. But when you factor in their fees, which can run as high as 1 or even 2%, the majority, over 90%, end up trailing their benchmark, okay? What this also doesn't say is how much they trail by. So if you missed the S&P 500, if you trailed by 0.001%, or if you trailed by 30%, this really doesn't distinguish the delta or the margin in which you missed. The other thing that I want to point out is someone might ask, well, Nick, why is it basically a coin flip over a 1-year period, but over a longer period, the majority, almost all these funds, underperform their benchmark? Very good question. In investing, luck is a heavy component, okay? In short periods of time, it's impossible to distinguish luck and skill. So when an active mutual fund outperforms, beats their benchmark over a 1 or even 3-year period, a lot of that can be explained by luck. As we move to the right, 5-year, 10-year, 15 years, skill wins out. Okay. So luck explains more of these funds beating their benchmark in the short term. As we move through time, luck diminishes, skill goes up. It's very hard after fee to beat any benchmark. Okay. And I'm not slamming mutual funds. I think there's a lot of smart people, a lot of analysts, a lot of very bright minds, very seasoned investors that work at mutual fund companies. The problem is their fees and the tax inefficiency. So high fees, not very tax efficient. That's how you end up with most, if not almost all, of these funds underperforming their benchmark. So if this was a casino and the casino said, you can come in here, we're going to make you feel good. We're going to give you cocktails. We're going to offer the latest and greatest games. We're going to rub your back when you're playing blackjack or craps. But at the end of the day, you were a 90% dog, meaning there was a 90% chance that you would lose all of your money and come in below expectation versus going across the street and going to a casino with no frills. You would probably not go to that casino after a period of time. Unfortunately, many people are blinded by the bright lights, the credentialed professionals, the army of analysts that work for these fund companies. A lot of times these mutual funds are sold by advisors that are receiving incentives or compensation from the mutual fund company to put these in your portfolio. So when you're playing the mutual fund game, as I call it, there's a whole complex designed to slowly, silently siphon off your money without you knowing it. A lot of these mutual fund expenses are hidden. They don't show up on your statement, but they're very much there. Mutual fund companies will never publish this information. This is basically an independent study, an independent scorecard that's readily available. Unfortunately, most retail investors don't know where to find this information. So again, if you work with an advisor that invests in expensive active mutual funds, that's often good for them and not so good for you. The empirical evidence would suggest you are swimming upstream. This is nearly an impossible fight to win. And there's no empirical evidence to suggest that an investor can choose the 10% of mutual funds that do outperform. So if your advisor comes back and says, well, I'm really good at picking mutual funds, or these mutual funds have done well over 1 year and 3 year, know that that's likely due to luck. And there's no way to choose winning mutual funds versus the rest of the pack. So as an evidence-based investor, as a person that pursues what works, I'm not even going to play this game. This is a loser's game, in my opinion. Investing is hard. We saw that in 2022. Take the low-hanging fruit, optimize for fees, tax efficiency, give yourself the best chance at achieving a favorable outcome. Okay, let's look at another piece. So this was put out by Creative Planning, and I hope you can see this. All right, so this is just another way of going through the information that I just went through at Spiva, except this came from Morningstar. Okay, so this adds U.S. mid-blend, U.S. small blend, and an intermediate core bond fund. And across asset classes, it's the same story. So again, over a 1 year period, these large blend, mid-blend, small blend, and bond funds tended to outperform. So this is a little bit different. So this is the opposite. So let me move my face. Percent of active funds outperforming their benchmark. So this is just basically saying it a different way or presenting the information a different way. So the higher the percentage, the greater the number of active funds outperforming their benchmark. And again, it's the same story. Over the short term, 1-3 years, luck plays a greater factor. Therefore, there's more funds beating their benchmark. As you expand the time horizon, let's look at 20-year. Only 10% of U.S. large blend and mid blend outperform. Only 13% of U.S. small blend, only 14% of this core bond fund. So it's not just me. Investors are wising up to this. So if I was a advice-seeking person working with a advisor, especially at a big bank or a broker-dealer or an insurance company, they're famous for using expensive funds that pay to get on the advisor's platform or that directly pay the advisor to use their funds, I would be showing them this. I would be asking them to defend this. And there is no defense. It's indefensible in 2023. Okay, so for people that think, oh, I'm working with an advisor, they're nice, they know my family, they've got my back. If you're invested in active mutual funds, I would very much question that partnership because it violates several basic principles, would allow you to at least stack the deck a little more in your favor. And now I'm going to show you something else that's kind of a watch what they do rather than what they say. A lot of these mutual fund companies are getting flack for their dismal performance. And so they're starting to silently pivot. And what's happening is ETFs are getting a greater share of the pie now. Many mutual fund investors, many financial institutions are getting rid of mutual funds. They're selling mutual funds and buying ETFs. In my opinion, ETFs are superior in every single way. In my opinion, mutual funds will not exist in 10 years. They are a dinosaur. And this is one example from ETF.com. 40 billion of mutual funds have been converted into exchange-traded funds over the past 2 years. So these are big mutual fund companies converting their legacy mutual fund positions, their legacy mutual funds into ETFs, okay? These are some of the numbers. I'm gonna make this a little bigger because it might be small. So this is investor flows now. So this is equity mutual fund flows versus ETF flows. So this is at the investor level. This is what investors are doing. They're voting with their wallets. In blue are mutual funds, equity mutual funds. There's been outflows basically every year since 2010. 2013 and 2014 are the exceptions. And it's really picking up steam, here. Conversely, look at the flows into ETFs. That's picking up steam as well. Investors are selling mutual funds, investing money into ETFs for lower fees, greater tax efficiency, greater transparency, less conflicts of interest. And there's a misconception with ETFs, and I don't want to get too far off the rails, but there's a misconception that ETFs equal passive investors. You just own the market, which is somewhat true, but not completely true. The explosion of ETFs has allowed investors to be very intentional. So if you're a person that wants to invest in cannabis stocks or Israeli small cap tech or Canadian stocks, there's an ETF for all of those asset classes. Those are very active thematic niches. There's an ETF for that. So you can be an active investor and get your exposure via ETF for all the reasons that I mentioned. That's not a passive portfolio. That's not an own the market and check out portfolio. Let's look at a few more. So this is the bond side. Look at the heavy outflows in bond mutual funds. And it's a little more disjointed here. And look, this is going to be a long battle because a lot of these mutual funds are owned in 401k plans, 403b plans, a lot of legacy plans that own mutual funds that might not be allowed to own ETFs. That's slowly starting to change, but that's probably going to be the last area or type of account to change. So this is a cool graph. So blue, again, is mutual fund, and this is as of 2010. Orange is ETF. Look at the market share of mutual funds. It's huge. ETFs are a small slice. Fast forward to 2022. Now ETFs are about 26% of market share between mutual funds and ETFs. So this is a trend that's really picking up steam. You can see by this above graph, it's really starting to accelerate, especially on the equity side. You have retail investors getting smarter. You have big mutual fund companies that are incentivized to sell expensive mutual funds, actually converting their legacy funds into ETFs. They see the writing on the wall, folks. So again, this is for folks that work with an advisor that own active mutual funds. I see it every single day. Your advisor might be a nice person. They might have your back. They might have worked with you for 20 plus years. Things change, markets change, the opportunity set of investment changes. And look, this has nothing to do with what we think the market does next. This doesn't require any hot takes about what the market does next. This is simply lowering your fees, increasing tax efficiency, and stacking the deck in your favor. And I'll leave you with one quote from Charlie Munger, who just published, Warren Buffett and Charlie Munger just published the Berkshire annual letter, and this is what Charlie Munger said. Active managers, he's talking about mutual fund managers, are living in a state of extreme denial. They are charging big fees for stuff that isn't doing their clients any good. It's a deep moral depravity. So that might be extreme, but this is starting to gain attention. In my opinion, it's long overdue. Advisors that are building their client portfolios using expensive funds are operating off an antiquated model. So that's either not being aware of this trend, being ignorant to this trend, or being compensated or incentivized by the firms that they work for to invest in these high-cost mutual funds. In either case, it's not good. I would bring all of this evidence to the attention of my advisor that is using mutual funds. If you don't like their answer, you could find a low-fee, low-cost advisor that uses ETFs. If that's at Pure Portfolios, great. There's dozens of independent RIAs that are already doing this. In my opinion, an independent RIA is a much more friendly place for your capital, lower fees, less conflict of interest. They're all independent, meaning they don't answer to Wall Street. They're not trying to maximize the bottom line. They're not allowing mutual fund companies to pay them a fee to allow those funds on their platform. It's just a much cleaner place, a much more friendly place for your capital. If you have any feedback, if you have any questions, feel free to email us at insight@pureportfolios.com. Thanks for watching. Take care.